Today I will be taking the second class. Here, in order to know accounting, there are some basic accounting terms which we should be well conversed, otherwise the language we cannot understand, that is accounting we cannot understand. So, some words are there, some terms are there which are called accounting terms. First of all, let us discuss about those things. First one is transaction. Which we have already discussed. Again in detail let us discuss. This is exchange of money or money's worth by one party to another. So, a transaction means there will be the presence of two parties, one party to another, that means there are two parties. Let us take an example. Mr. X gives rupees 5 lakh in check to Messrs. Utkal Automobiles for a car. So, what are the two parties? Mr. X is giving means Mr. X is one party, and to whom it has been given? To Messrs. Utkal Automobiles. So, Mr. X will write that I am giving rupees 5 lakh in your check means through bank and getting the car. So, one party, that is Mr. X, is giving cash or a check, and the other party, that is Messrs. Utkal Automobiles, is giving the value of it or money's worth, that is the car. So, exchange of money or money's worth by one party to another, this is called a transaction. I hope you have understood this term. Then the second term we will discuss is event. Event is the end product or end result of the transactions. In that example, Mr. X has taken the ownership of the car, that is the event, and Messrs. Utkal Auto have given the right to Mr. X. This is called an event. This may be a business event, but it is not recorded just like a transaction is being recorded in accounting, but it has got its own implications, that is it is material so far as the business is concerned. After event we will come to debtor. Who is a debtor? Any person or firm or company who takes goods from us. Goods means only those goods in which we are dealing. Suppose we are a bookseller. When we are selling books, that is called goods, but if we are selling our car, if we are selling our say furniture, we are selling our computer, that is not goods for us. But for the computer shop it will be goods, for us it is an asset, it is not goods. So, when I am telling A debtor is a person who takes goods from us on credit, that is called a debtor. A debtor is our asset because ultimately we will be getting some money from him in future. So, a debtor becomes an asset for us. The opposite of debtor is creditor. If we are getting some goods, if we are purchasing some goods on credit from somebody, he is our creditor. If we are taking a loan from the bank, he is our creditor. So, creditors are the firms and persons, those who have lent money or those who have supplied goods to us on credit, that is called creditors. After that we will come to capital. These creditors are our liabilities. What is capital, what is liability, let us discuss. Number 5 is capital. An amount owing to the proprietor is called capital. When you are starting your business, you are the proprietor. You are giving some amount, you are investing some amount in the business. That does not mean that you will forget about that amount. That is the amount which you definitely expect to get return after some days or some years. So, the business owes that money to you. You are the proprietor. So, the amount which the business owes to you is called the capital. You are investing the capital means you will be expecting to get it back, if not tomorrow, after some days, after some years. So, that is called capital. Number 6 is liability. Amount owing to outsiders. Amount owing to outsiders is called a liability. Think that you are the businessman, you are having the business, or you are the manager of the business. Whatever amount you have got from others, not from your proprietor, leaving aside your proprietor, if you are receiving some amount from the bank as a loan, bank is your creditor, so it is a liability because you have to pay at a later date to that bank. So, a liability will have to be paid at a later date to an outsider, not to the proprietor. If it is to the proprietor, then it is capital. If it is to the outsiders, then it is a liability. A liability may be a creditor, may be a loan, may be bank overdraft. There are so many examples of liability. Now, coming to asset. Opposite of liability is asset. An asset gives you utility, gives you benefit of long lasting nature. Suppose you will be purchasing a building or a piece of land or some machineries or a plant or some furnitures or some equipments, a computer, whatever it may be, these are all called, or your vehicles, these are all your assets. Assets can be again divided into 5 categories that we will again discuss. So, asset will include fixed assets, current assets, . Liquid assets, then intangible assets, then vesting assets, and number 6 fictitious assets. So, these are the 6 types of assets. First one is fixed assets. Fixed assets are those assets whose value more or less remains fixed. Suppose you are purchasing a land, building, plant, furniture. So, barring some depreciation which is to be deducted from time to time, year after year, that amount remains the same. So, the land if you are purchasing, rather there is appreciation, no depreciation, but regarding building, plant, furniture, motor car, etc., there will be depreciation, but the depreciation is not very much. So, out of 50 lakhs maybe 5 lakh rupees we are deducting. So, 45 lakhs. So, more or less the same amount will be repeated or it will remain fixed, and these fixed assets give us the productivity. By using these fixed assets we produce goods and we sell them so that we make profit. So, that is fixed asset. Then coming to current assets. The technical definition of current asset is that the asset which is convertible to cash within one accounting year, that is called current cash or current asset. So, current asset will include your debtors, bills receivable, stock, all these things will be converted to cash within one accounting year. If there are debtors, debtors means the persons who have taken goods and credit from us. So, if they have not paid today, after 1 month or after 2 months or after 3 months they have to give us. So, in this way that asset debtors is being converted to cash within a period of 1 year, 1 accounting year. That is why it is called current asset. Similarly, bills receivable. Bills receivable is a negotiable instrument which is received by us when we are giving some credit to some persons or some firms. So, that bills receivable is a type of document which we have to show them after 3 months or 2 months, they will give us cash. So, that is also again convertible to cash within one accounting year. Coming to stock. Stock means stock of goods which has been there, we have purchased and it is not yet sold, but it will be sold, definitely it will be sold within one accounting year. So, it is called another current asset. Then liquid asset. Actually, liquid asset is a part of the current asset, and liquid asset refers to the liquidity, those assets which are already in the form of cash or can be readily convertible into cash, that is called liquid asset. So, the most liquid asset is cash. Cash, then your cash at bank, government securities, which is easily convertible into cash. So, these are all, you just write a check and you get money. It is converted to cash very easily, that is cash at bank. If you have got bank balance, that is there. Similarly, government securities, any security from the government, a bond or something, you can give it back to the government and get money. If not to the government, then also you can go to a bank and keep it as a mortgage and receive some cash. So, this is easily convertible into cash, that is why it is called liquid asset. Then coming to intangible asset, all these assets are tangible. Tangible because we can see them, we can touch them, we can lift them, we can use them. So, these are all tangible assets. The next example is intangible asset, and intangible assets that refers to those assets which cannot be touched, which cannot be seen, but more or less it gives us the utility of an asset, it gives us some benefit in the future, so that it will be called intangible asset. One is goodwill, copyright, trademark, and patents. Goodwill refers to the good reputation of a firm. If you are having good reputation, like suppose Allen Solly, a garment manufacturer called Allen Solly, mostly it imports goods and the quality of the goods is so good. It is so good that you can give 1500 for a shirt, whereas these shirts are also available for 500 rupees. Why? Because of its goodwill, that it is a good company, it uses proper proper cloth, proper stitching is there, style is good, all these things that increases the goodwill of the company, and for that it is charging more money from us and we are ready to give and gladly we give. So, in this way its profit is increasing. The impact of the goodwill is that in comparison to the others you are making more profit. So, that is called goodwill. Similarly, copyright. When you are writing a book, the author is writing a book, when it will be published, he will have the rights. Whenever it will be printed, permission will have to be taken from him and he will charge something for that from the publisher, from the printer. So, that is called copyright. Then trademark. Trademark, suppose we are using shoes, Liberty shoes or Woodland shoes. So, that Woodland is the brand name or that is the trademark. We cannot manufacture some shoes and give a label that it is Woodland. Police will cut hold of us, because the trademark has been registered by them and it cannot be used by anybody else. That is called trademark. Similarly, patent. Patent is for medicines and other technical things, which the patent right is always with them, those who are the inventors of that, and they also, if will give the right to produce those medicines or those goods, then they will charge something for their patent. Patent is their ownership. Then we will come to wasting assets. Wasting assets mainly refers to the mines. Mines means mineral products are there, it is not for all time to come, it will be wasted, it will be, the more you extract from it, the less will be there in the stock. So, one day will come when it will be of zero value. So, this is called wasting asset, whether it is coal mine or iron ores, or you can say these oil wells in United States, sorry, your Arabian countries, that will definitely go on to zero. So, that is called wasting asset. The more you exploit, the more you explore from that, the less will be there in the stock, the value will be going on declining, that is why it is wasting assets. Then coming to the fictitious assets. The meaning of fictitious is false, that means actually it is not an asset, but it is in the asset side of the balance sheet. These are all discount on issue of shares, then at the time of issuing the shares, if you are giving some discount, then for the time being it will be there in the asset side of the balance sheet, but it does not give you any utility in future. So, it will have to be written off, that you will read later on, but for the timing you just know that discount on issue of shares, preliminary expenses, so preliminary expenses are the expenses which are incurred by us before starting of the business, before commencement of the business. Like suppose you are printing the prospectus of a company, to float a company. The business has not yet started, business is not commencing now, but you have already spent, that is called preliminary expenses, and it will be there in the asset side of the balance sheet. And even though it does not give us any utility in future, it has already been incurred and we have to write it off in future, but for the time being it will be there in the asset side of the balance sheet in the name of preliminary expenses, which is a fictitious asset. So, these are the different types of assets. Then after that, we will come to goods. Goods we have already discussed. Goods refers to only those goods in which we are dealing, the company is dealing, the entity is dealing, not all the goods. Like I am purchasing a necklace for my wife. This is not goods for me, but it is goods for the jeweler, because every day it makes and sells jewelry. But for me it is an asset, it is not goods. After goods, then we will come to, after asset rather, we will come to expenditure. Then expense, then loss, then gain or profit. So, spending money for getting a benefit of very lasting nature is called asset, that we have already discussed. Then spending money for getting a benefit of comparatively less lasting nature, but still then long period, is expenditure. For example, suppose we are spending on advertisement, and the advertisement in the TV will be for 1 year or for 3 years, and for that they charge 3 lakh rupees from us. So, that is called expenditure. And expense, same thing, spending money for getting a benefit of very short lasting nature. Suppose we are going in a bus fare we are giving 50 rupees. So, that is only for 2 hours, after that the benefit is gone. Similarly, suppose we are consuming one cold drink. So, its effect is over within say half an hour. So, that expense will be called expense. As it is, as such there is no watertight compartments between expense and expenditure, that up to 30,000 it will be expenditure, below that it will be expense, not like that. Depending on the circumstances you will have to decide, you will be able to decide whether it is an expense or expenditure. So, spending money for getting a benefit of short lasting nature is called expenditure, expense. Then loss, spending money for getting a benefit or for getting no benefit rather. We are spending money but getting no benefit, then it is a loss. Suppose take the case of loss by accident. We have spent 5 lakh rupees on our car when we have purchased. By accident, suppose it was destroyed. Loss by fire, it was destroyed. Loss by war, whatever it may be, any type of loss is that. You have already spent money, but you are deprived of getting any benefit. So, spending money for getting no benefit is called loss. Then opposite of loss is gain. When your sale proceeds will be more than your cost, then there will be profit or gain. Then equity. Actually, total of the asset side is equal to total of equity. What you all have is your equity. Equity can be divided into two types, that is owner's equity and outsider's equity. Owner's equity is nothing but capital and other all the equity shareholders funds, that is your reserves etc., that will be also included in this owner's equity, and outsider equity is liability. As I have told you, if you take the capital and the liability in one side, then the other side will be asset. Total of the assets is equal to liabilities plus capital. That is, owner's equity is capital and outsider's equity is equal to liability. Both the take liabilities plus capital is equal to assets, which is called equity. Again, we will be coming to the accounting equation. This one is called accounting equation. Accounting equation says assets is equal to liabilities plus capital, or it implies that assets minus liabilities is equal to capital, or assets minus capital is equal to liabilities. These are all equations. This is accounting equation. A minus L is equal to C. Assets minus liability is equal to capital. Then this capital, the other name of this is called net worth. So, this is number 13. Number 14 is net worth. Again, net worth precisely means the capital, because net worth is equal to assets minus liabilities. Assets minus liabilities in this way is also called net worth. From the same equation we have derived so many things. Then drawings. Opposite of capital is drawings. When we give some amount to the from our private property to the business, it becomes capital. But when we take for our private use some goods or some cash from the business, then it is called drawings. So, drawings is just the opposite of capital. Then we will come to bad debts. When we are selling goods on credit, sometimes we may not recover the amount of our sale proceeds from our debtors. We can go to the court of law definitely, but the thing is, suppose he dies and he does not have any property left with him or with his family, then where from we will be getting? Or he becomes insolvent, then also that becomes our bad debt. Bad debt is a loss. Now we will be discussing about the functions of accounting. Actually, there are many functions of accounting, but the most important ones only we will be discussing. The first one is systematic record of business transaction. Systematic record of business transactions means it is the function or duty of the accountant to systematically record all the business transactions that are coming on his way. So, a business may have different business transactions, but all the transactions which are material of course will be recorded by the accountant in a systematic manner. That is what is more important, is that systematic manner. Systematic manner means there is a particular system, particular manner in which all the persons who know accounting will write. That is called systematic record. Number 2 is protecting the property of the business. protecting the property of the business. How? How the accountant will be in charge of protecting the property of the business? First of all, when the purchase is made, the accountant records it. Then he keeps it in the stores. So, in this way it has been enlisted that we have got this asset. So, that is in the books. Nobody can take it away without their permission. Number 1. Again, when we are maintaining the or repairing the fixed assets, that is also being maintained, because without proper maintenance that will be destroyed or that will be wasted very soon. So, that depreciation is provided, maintenance expenses are incurred, repairs are undertaken, all these things are done under the supervision of the accountant. Accountant will write all these things. So, that is the way in which it is protected by the accounting, or accounts will protect it. Then communicating results to the interested parties. Communicating the results. What is the result? Profit or loss. So, that profit or loss is known by preparing the profit and loss account. So, the profit and loss account is prepared again by the accountant. So, thus accounting has got a function to prepare the profit and loss account, find out the profit, that is the result, and intimate it to the top management, to the other users, to the society, to the government, to the everybody, as we have already discussed the users of accounting, in users of accounting. So, both external as well as the internal users are there. To them the accountant will have to communicate the results. Communicate the results means the profit or loss. Then the last one is compliance with legal requirement. Compliance with legal requirement. Compliance with legal requirement means whenever you are doing your business in a small scale, very small scale, like a battle shop or something, it may not be compulsory on your part to maintain the accounts. You can maintain the accounts for your own benefit, but the government does not force to prepare any accounts. But when it becomes a large scale industry or large scale business, then there are certain restrictions, there are certain enforcements by the government that you have to keep a record of all the transactions. You have to find out the profit or loss. You have to prepare your balance sheet. In case of a company, you have to publish your balance sheet also, profit and loss account and balance sheet, and in addition this cash flow statement, etc. So many things are compulsorily maintained, that is the instruction of the government that you have to maintain it and publish it for the knowledge of the public as well as the other persons who are interested. Those who want to see that, they can see that, that has got to be published. So, this is compulsory and it is the work of the accountant to do all these things. So, these are precisely the functions of accounting. After functions of accounting, we will come to advantages of accounting. Advantages of accounting. What are the advantages of keeping the accounts? First one is replacement of memory. You know, human mind has got its own limitations to remember some amount of data. It is not that we can remember any number of information which is coming across, we are coming across them. It is not possible, because this hard disk, human mind is a hard disk and it has got its own capacity. Beyond that capacity it cannot remember. For example, suppose I will be giving you 100 rupees. At the end of the day, what all you have spent out of 100 rupees, you can give a list that I have spent 5 rupees on this, 8 rupees on this, 10 rupees on this, like this you can give, and the balance is 5 rupees left with me. But if I shall give you 5 crores rupees and you have to spend it within 1 year, after 1 year, can you tell me? It is not expected. It is not expected that you can tell me the details of the accounts or details of the transactions which have taken place and what is the balance left. That can be done through accounts. If you jot it down, if you write it down, all the expenses you have taken, all the expenses you have incurred, then only you can tell me that I have spent 3 crores rupees and I have got 2 crores rupees with me. So this is possible only when you keep the accounts. So that is an aid to your memory, or it is a replacement of memory. In lieu of the memory, this accounts also will come to help you. The second one is evidence in court. Evidence in court. When you have done something and you have written it in your books of accounts which cannot be changed, if required at the time of a case in the court, you can go to the court with the evidence, that is your accounts book. That you can write, see the cash book, we have not given any money to this political party or to this gundas or to this unsocial people like this. You can show your cash book, that is nothing but your accounts. So at the time of requirement, if needed, you can show the accounts and that will act as an evidence in the court of law, and also the honorable judge will honor it that these accounts are maintained, so definitely no cash has been given in these bad ways. So that is an evidence in court. Then settlement of tax disputes. There are various types of taxes, like starting from your income tax to the VAT, there are different types of taxes. If you maintain the accounts, then only it becomes possible on your part to convince the tax people that we are not evading tax, that this is our purchase, this is our sales, this is our wages we have paid. So the balance is the profit which is coming to suppose 60 lakhs rupees. So on 60 lakh rupees you can take say 30 lakhs rupees if it is at 50%, or 18 lakh rupees if it is 30%, then that will be your evidence, or that will be your proof that you can take the help of the accounts to settle the tax disputes. If the tax authorities will demand more, you can show your accounts, this is our accounts, you cannot claim more than this. So that will help you at the time of settlement of tax disputes. Number 4 is sale of business. At the time of sale of the business, when your business will be sold by yourself to somebody else, to some other parties, then you can show them these accounts that these are the profits we are making, these are the assets we are having, these are the liabilities only which we are having. So you have to give us this much of amount. So the purchase consideration can be fixed only by showing these accounts, because this will be helping definitely to not only you to convince him, but also him to be convinced that yes, it is true and it is all shown in the books of accounts. So I am ready to give you this much of amount as the purchase consideration. So that is at the time of sale of business, it is of much use. Then comparative study of profits, expenses, sales, etc. If you want to find out what is the reason of losses, go through the cost of that year, last year and this year. Then we can know that you have spent more or less. The costs incurred are more in this year in comparison to the last year. So how can you do it? Until and unless you have written it. If you have written, if you have done the accounts, then you have written, so that you can analyze them, compare them with the last year's performance, again previous year's performances, etc. And that will be of great help if you maintain the accounts. So not only the expenses or the costs, but also revenues also you can get it from the accounting records. The next point is, it helps an insolvent person through factual data. What is insolvency? Insolvency means when your assets are less but your liabilities are more. What is the consequence? If your assets are less but liabilities are more, even though you sell all the assets, all the liabilities cannot be paid in full. Suppose you have got assets worth rupees 60,000, but your liabilities are 1 lakh. Then all the liabilities or the outsiders, they will claim that give me my money, but you will sell it, and you sell your assets and you get only 60,000. How can you give another 40,000 rupees from which source, if that is the only source of your income or business? Then you will go to the court of law and will beg for insolvency. You will beg the court that please declare me as insolvent, so that no other person will disturb me. And the court at that time will see your accounts. Show me your accounts, whether your assets are more or liabilities are more. Then what are your transactions you have taken, why you have taken all these things. All these data can be supplied, then only the judge will be convinced. So at that time, if you do not have the accounting data with you, how they will be satisfied, how they will declare you as insolvent. So that is the way in which you can get a help from the accounting department, that the maintains, if the accounts are maintained properly, then you can show it to the honorable judge and they can declare it you as insolvent. Then number 7 is assistance to various parties. As we have already discussed, accounts will help with its factual data to many type of persons, both internal as well as external, to the managers, to the employees, to the entrepreneurs, so far as the insiders are concerned, and also to the outsiders, the general public, the consumers, the government, the tax people, everybody, they will be satisfied with this. So these are of much assistance, much help if you are maintaining some proper accounts. Now we will discuss the last point of today, that is the limitations of accounting. Accounting has got its own limitations. it cannot touch some of the areas. So, what are the main limitations of accounting? The first one is historical in nature. We claim that whatever we have written, on the basis of that, the next year's performance will be structured or planning will be made on that. But whatever we have written may not hold good, because these are all history, or the data which we have recorded is historical in nature. Just like by doing a postmortem, we can know what was the reason of the death of this person, but we cannot give him medicine after that and can make them or make that person live. It is just like that. Suppose we have purchased a piece of land some 10 years before. When we went through the records, it was purchased only for 10,000 rupees. But after 10 years, if we have to purchase a similar quantity or similar amount of land, then it may be available for 10 lakh rupees. So that 10,000 does not help us anyway in order to determine the value of this land or a similar land which is going to be purchased after some years. So this is one of the limitations, that we go by the historical cost, but the replacement cost may be much more or much less than that. Similarly, suppose one building we have purchased, but that building was purchased 25 years before. Now its value is negative, it will have to be demolished, because it is dangerous to live there. So if we will say that we have spent 50 lakh rupees in building that building, now it is of no use and it is having minus value. So this is all postmortem reports, or you can say historical in nature. So this is one of the limitations. Then it matches current revenue with past cost. When we have purchased some goods, say last year, maybe we have purchased it at a very less price. Now when we are selling them this year, that means in the next year, when we are selling them, we may be, due to some reason or the other, we may be getting much more money than the cost. So we are complacent that we are making huge amount of profit, and accordingly we will think that in the next year also we will be again making some profit. But actually this matching is not perfect. Why it is not perfect? Because the cost which we have given, that was some days ago, but the revenue which you are getting is at the present price, and due to inflation it may so happen that last year's price which we have purchased for 110 rupees, this year maybe we will be purchasing the same quantity for 150 rupees. If the selling price is 160, we need not be very happy that we are making a profit of 160 minus 110, that is 50 rupees, because the price or the value of money has been decreased. So now it is available for 150. So you should compare, you should match the cost of today, that is 150, with 160 in order to get the real profit, true profit. But we are comparing 160 rupees, that is the current revenue, with the past cost, that is 110. So we are very happy that we are getting 50 rupees profit, but actually it is not the case. We are making less profit, but thinking more profit has been earned due to this false, or you can say wrong approach of accounting. This is another limitation. Third limitation is effect of price level changes. The same thing I was telling you, effect of price level changes. When we are going to purchase at a given price, that is the historical cost at which we are recording, but its price may be increased due to price level changes, that is inflationary and deflationary changes. So, with the economic cycle, presently it is due to the inflation that the price at which we have purchased does not reflect the exact amount which we are showing it at the time of sales. So, the effect of price level changes, that is inflation etc., is not taken care of by the accounting, because the accountant always writes the historical cost and the present revenue. Then number 4, it records only monetary transactions. It records only monetary transactions. Monetary transactions we have already given beforehand also, that only monetary, anything which cannot be termed in economic or monetary terms, monetary quantitative terms, it is not going to be recorded by the accountant. If we will say that a good manager, and due to his capability, due to his you can say popularity, we are making more profit, definitely it is an event which is affecting the business, and that too favorably, but that is not given any importance so far the accountant is concerned. The accountant will say, what shall I write? A good manager, because it is not expressed in terms of money, I cannot write it. Whether he is good or bad, if he is taking 50,000 rupees salary, that only I can write. How much service he is giving, I cannot write. Whether he is giving good service or bad service, that I cannot write, because good, bad and this popular etc., that is having no use in accounts, because they cannot be expressed in terms of money. Qualitative information is not within the scope of accounting. That is one of the major limitations. Then the next one is unrealistic information. From accounts, we very often get very unrealistic information. The example which I was just giving you, that is your land purchased 20 years before for 10,000, has nothing to say about the land, the same land or the similar type of land costing now 20 lakh rupees. 10,000 and 20 lakhs, hell and heaven difference. So, that is an unrealistic data which we are recording, because the data will have to be recorded by the accountant in its historical cost, that is 10,000 means 10,000. We have given 10,000 rupees, that is the cost of the land at that time, it will continue in the asset side of the balance sheet as a fixed asset, land 10,000. Next year land 10,000, like this. So, what happens due to this? Is it real? It is unreal. So, if we will say that only 10,000 rupees, this year also we can purchase the same amount of land for 10,000 rupees, but no, you cannot purchase even 1/100th part of it by giving 10,000 rupees. So, that is unrealistic in nature. Then results are not objective. Accounting results, that is the profit which we have arrived at, result refers to that, is not objective. Objective means whether you tell, whether I tell, whether anybody tells, it should be the same. 5 plus 3 is 8. You ask anybody, if he tells 8 it is correct, otherwise it is wrong, that is objective. But the profit which we are getting by adopting one method of depreciation may not be the same by another accountant who uses another method of depreciation. If you are using straight line method with 10% every year and I am using diminishing balance method with 10% on the diminishing balance, in the first year your profits, your depreciation amount will be same and the profit will be same. But in the second year, other things remaining the same, the depreciation will be more in case of the original cost, whereas in case of the diminishing balance method it will be less. So the profit will be more in this case. That person or that accountant who is using diminishing balance method, having the same data, but the profit will be opposite, I mean less in this case. The diminishing balance method who have used, his profit will be more, and the original cost method who have used, that will be less. So it is not objective, it differs. Then the last one is biased and subject to manipulation by individual If you have heard the word window dressing, what does it mean? Window dressing means we will be showing our assets at a bigger price than actually they are. So if I have got a bias to show the assets at a higher figure, then I can show it at a higher figure by providing less depreciation. The accountant here has got the liberty to use a method of depreciation which amounts to less. So the depreciation if is less, then the asset value will be more. So this is called window dressing. Why window dressing is made? Due to this bias. Accountant is a person, is a human being, and every human being is having some bias. So due to this biased nature, we sometimes do some mistakes, and the data which we are writing may not be correct. It is manipulated. It can be manipulated also. So the accountant or the accounting is not free from this type of manipulations. So these are some of the limitations of accounting. We have to keep in our mind the limitations of accounting while going through the accounts of some persons. We have to keep in mind that he might have done this window dressing. All these things should be taken into consideration. Thank you.